Welcome to our latest webinar for corporates. In this series, we'll be examining recent events and looking ahead at what might be in store for financial markets and the economy.
Good morning, everybody. Well, you thought we'd change it up, so I'm in the office today, and another change to the usual format is we're going to allow Piers to go first in terms of presenting the technical view, because it's been a couple of months since Piers has presented, and I also think it'd be interesting to have Piers' views on the significant market moves that we've seen over the course of the past couple of months. So you can see from the contents slide that we're going to look at the technical analysis and charts view first, and then we'll go through the macroeconomic view, looking at what's happening in economic growth, then looking at what's happening in inflation, what that means for interest rate expectations, how we're seeing confidence alter in both consumer confidence and also market confidence generally. And then we'll look at the US dollar, because we've seen a bit of a slide in the US dollar after made some very healthy gains in the first half of Q2. The last few weeks have been a significant setback for the US dollar. So will that continue? And that's followed by the disclaimer and the Q&A. But without further ado, I'd like to hand you over to Piers Leslie, who'll give you an update on the technical analysis outlook.
Right, hi there. I'm going to look at the markets using a forecasting technique that's been around for centuries. And you'll see how many of the forecasts I gave last time I was on this a couple of months ago have actually played out well using these old charting techniques. Some people mistakenly think I'm trying to show something new that's just been around for the last sort of 25 years, but they've been around hundreds of years. So these are very old techniques. They seem to work well, and that's why we try and show them to you. Like Neil and his fundamental way of looking at the markets, price will always be affected when forecasts of unemployment or inflation or interest rates are wrong and surprise the market, then the price moves. Or more importantly, the one thing always you should keep in the back of your mind is it's that unknown event that happens that blindsides the market. You know, we've had a good few examples of those. Well, not good example, but we've had examples of that over the last couple of years with COVID. No one was ready for COVID. The Ukraine situation, no one was ready for that. In January of each of those years, people weren't ready for that. So there's always those that might come and hit these targets that we have. But in all market conditions, I'd expect these still to keep working. So this is a look at how the market looks at the moment, what we're expecting, and where we see the next important levels to watch for. So the first chart that we're looking at now is the dollar index chart. And on this, there's two levels we always seem to look at, which is the retracement levels of 38.2% and 61.8%. So here we can see quite clearly that the move that we had from 2000 going down to 2008, when it rallied back up with the dollar, you could see that the dollar stopped at the 61.8%. And then it came back to the 38.2%. And then last time we were on this call, we were rallying off the 38.2%, heading higher. And we said to watch out when it got to the 61.8%, we were expecting some sort of stall to come. And that's the stall that Neil was just mentioning in his opening address. We're seeing the dollar start to stall. Why is it stalling? Because it's tried getting above that 61.8%. It still didn't quite have the force, and it's come back down slightly to be sitting at that level. So what's going to be very important this month is the end of the quarter. So in a few weeks, we're going to see, can it break that 61.8%, or will this be a spike and we'll see a bit more dollar weakness? So that's a really key area to watch as the month progresses. Now, we also looked at the Bollinger Bands, and you can see that we're at the top of the Bollinger Bands as well. So it's another reason why the market is sort of stalling. So I think it's just a key area to watch for the dollar. We've had a good move, and now it's just starting to stall. But if it breaks above that, there'll be a sudden surge of people want to get into the dollar again. So that's the point to watch. Now, if we look at the next slide, I look at the dollar index again. And again, here, we've got the same sort of time period. But look at this. We have that yellow bit in the middle, is called the Ichimoku cloud. And basically, it's a historical lagging moving average. It's built up of lots of different weekly time periods or whatever time periods you look at. But on here, we're looking back quarterly all over that time. But the important thing is if price gets above the cloud, then it's considered positive. But what you really want to see is the lagging line, which is that black line that is a bit further back from the price that I've highlighted. That black line above the cloud confirms the break. So here, I'm still looking for longer term dollar strength to come because I think that any moves back down will now find the cloud as support and then the dollar will rally. So if you do get pullbacks at this stage, I think they are just that, pullbacks that get bought into. And that's the important thing to look at. So where can we pull back down to? I would expect around maybe the 98 area, but not much below 98. If it starts to get below 98 on the dollar index, then maybe the market is starting to change its feeling on the dollar index and the dollar as a whole. But if we see a close above 102 on the dollar index, then be prepared. I feel that that is a signal that we are going to see another surge of dollar strength come. So let's see how that plays out into the currency markets. It's all well talking about the dollar index, but most people want to buy the currencies. So we'll start with euro dollar on the next slide, because that's the world's largest traded currency pair. So it's always good to see what this is doing. Now, this is the chart we had last time I spoke. And on this chart, we looked again at the move down from 2008 to 2016. We saw the rally back up. And on the rally back up, we could see that the market stopped at the 38.2%. Then the market fell back off. And again, it rallied back up towards that 38.2%. And it stalled. So what that tells you is that the downward move from 2008 to 2016, from a Fibonacci point of view, is still intact. It's still in the downward phase. To stop that, you want to get above the 38.2%. We had that pink dashed line going up. And I warned that if we got below that line, if the price got below that line, I'd look for a test down towards the 104 area. And we got that test. The line broke and we got the test down to that 104 area. And the 104 area held, and we're seeing a rally off there. And that's the rally that Neil was talking about, a bit of dollar weakness coming back just at this stage. Now, why did the market stop there? Not just because it was the previous low, because on the next slide, if we look at the next slide, we can look at the Fibonacci extension. So instead of looking at the retracements, we take the move down, we measure the move back up, and then from where the move back up is, we start putting those projections of the same percentages down. And you can see that 103.83 was the 38.2% extension swing. And that's why the market there, that's why they took some profit. They took some profit and we're seeing the market rally back up off that area. But at this stage, it could just be that it's a rally off that area that then sees it break down. So it's a bit like the dollar index. You're watching some very key levels at the moment. So the dollar index, we're watching that 102. And here we're watching 103.80, 104. While it can hold above that, you're still in this little rally phase, bouncing off the 38.2. And you could see a move back up, maybe up to sort of the 108, 110 area. But where would I start to think this is more than just a pullback within a move lower? If it starts to get above 112. If it starts to get above 112, then you're looking at a bit more serious decline for the dollar. But we also know, where do we have to really worry that the dollar's coming back into fashion and people want to buy the dollar? It's if we see it back below that 103.80. So sustained trading and then a quarterly close below 103.80, that would open up downside targets. So we've sort of got, if you look below there, we've got potentially, you could see it down to 97. And then the 61.8 is right down at the 0.90 area. So it could be some big moves if we start to see it through that 103.80. So it's a very key level to watch. Now, if we move to the next slide, we're going to move to sterling. So the best way I find to look at sterling is the sterling index chart. And I know probably a lot of you are bored every time I go on and on about this, but it is key to sterling, because I've heard many people many times get excited, sterling dollars rallying or sterling euros rallying, but they aren't looking at this index. Because this index, if we take the move down from 2015 down to 2016, and we don't take the very bottom spike, because that was the flash crash and no one was quite sure where the low was, so we take the next low, which was a confirmed low, you will see that on 11 attempts, the sterling index has failed at that 38.2%. Now, amazingly, I know there's still some people who say, oh, this 38.2%, 61.8%, it doesn't affect me. Well, this is where it does affect you, because 38.2% has held sterling every time since the Brexit crash. So that is the key level you need to see a quarterly close above if you want to go around and start talking about sterling strengthening. Because if you get a quarterly close above that, then you have a trigger. And sterling is probably going to strengthen and go up to the 61%, which is 69. But again, last quarter it failed. This quarter is just on a small downward move so far. But it's a bit worried because price is right on that. There's a dash blue trend line coming up there and the first retracement, 23.6 at 62.30 area. So it'll be a real shock for sterling if sterling was to suddenly close a quarter below that trend line and the 23.6% retracement. So if you want sterling strong, you really want this support that it's testing at the moment to hold. Because if you suddenly find yourselves going down into the 61 area, it could be the start of something much more significant and bad for sterling. So you need that, as I say, to hold. If you want long-term it to rally, you need it through 38.2. If you want sterling weaker, you just got to pray it breaks that trend line and it will collapse. But those are the levels to watch at the moment. They're tightening up, so this is going to force an issue soon. But you've got to be aware of those if you trade sterling, I feel. So we move to the next slide. We'll look how does that actually impact into the currencies. Now, a couple of months ago, I put this chart on and I said, watch 128, 133 range. Any break outside that gives you the signal. And I said below 128, then 124.90, 125 should be the next support target. You can see that price went down to that 124.90. It's where we're just above now. And it's above the bottom trend line. It actually went further. It went all the way down to the 76.4, just above that, the 127.7 area, then rallied back up. But the key is going to be, can it hold above that trend line and that 124.90 into the end of this quarter? If it can, then maybe it rallies back up and we see a bit of a move back towards 128, 130. But if it doesn't hold there, then that's not good. If it closes below sort of the 124.80, 124.60, 90, say, area, that would be negative and probably open up further sterling dollar downside. So let's have a look at the next slide here, because the next slide has the Bollinger Bands on. And this also shows why sterling dollar bounced where it was. Sterling dollar was down there, and that was good. So it bounced off the retracement we had on the previous chart and the bottom of the Bollinger Bands, and it's coming back up as we see at the moment. But it's still very, very worrying that we're down here on sterling dollar. So if we were to break down below that bottom Bollinger Band, and they seem to be starting to point outwards, which is a bad sign, which probably suggests maybe a bit of a move lower could be possible. So I think the risks at the moment are that if the sterling dollar does rally, it will get sold into. And on the next slide, we'll see something that sort of just confirms that, I think. So on this chart, I'm looking at the monthly chart, and you can see the Bollinger Bands, those two red lines, they're facing outwards as the price goes down. So they tighten and then they point outwards. And that's normally a directional move. Shows that the market that's the new sense of direction. But we can have a look maybe at one line that could be helping sterling dollar. and it's this 123.60 area. So if you've got a monthly close below 123.60, then I would see that as a bad signal because it's where the market rallied off in 2020. If it fails there and we get a monthly close below that, I think you're opening the way much lower. If it can hold above 23.60, you might get a bit of a rally, as I say, up into the high 120s. There's one thing I would say here, that at the moment, people are saying, oh, look, this is all right. We're sort of got a higher low at this stage. But if we put it onto the next slide and we look at it as a line-only chart, you can see that trend line that we had is broken. And that worries me because we're going to have a couple of months now below that trend line. So you really need, if you want sterling dollar high, you want to see sterling dollar back above that trend line. You want to see the one sort of a 23.60 area hold. So keep an eye on those two. We'll keep you posted on the daily and weekly charts and on these webinars. But that's going to be a key couple of months for sterling dollar now, that it has to find some support here because below sort of 123.60, I don't think the outlook is good for it. So if we go to the next slide, we're going to euro sterling. So this is the quarterly chart, and this is the same chart we were looking last time. And on there, I said that the 38.2%, which comes in at 84, had not broken. Now, 84 is about the 119 level on sterling euro, if you look at sterling euro level. So you need it above 119 to really get hopeful that we are going higher. But the 38.2% of this rally since 2015 in euro sterling has held again, and you had a positive quarter so far this quarter. So last time I was looking for a move up towards 86.50, 87.50, and we've sort of got up just short of that area. So we've had the move we were looking for last time. The market has rallied off that, and the key will be in that 84 area if we come back down to the 84 area. And at this stage, I still see that 87, 86.50, 87.50 area as resistance. So I'd watch that area. It should stall as it gets into that area. So in sterling euro terms, that's 114.30, 115.60. There should be good support in that area. And on the next and final slide, I look at sterling, euro sterling on a monthly chart. But here what I'm trying to do is something slightly different. I'm trying to say, let's look at all the points of congestion. So there's a rule in technical analysis, the rule of polarity, and that says old support switches to resistance. And here we can see many times all those red circles, it seems to swap from support to resistance. So I think it's just worth putting those on the chart, taking off all other studies and just saying, look, where does price struggle? It's a bit like when you go on a pub crawl, where the pubs you stop and always like to go back to and stop at. That's like the same with currencies, where it goes along and it likes to stall. So I'll do the sterling euro levels here, make a bit of a change. I usually talk about euro sterling. So while you're below 119.65 on sterling euro, you have your first level around about 116.77. And then below that, there's not much going down to 115, then 113.44 and 112.21. But those are areas I'd look for congestion. Where do I get positive again, sterling euro, that we're going higher? Above 119.65 on a monthly close, then you'll break the bullish outside month, which happened 2 or 3 months ago, which has caused this rally back up. And the next slide, I think, is my disclaimer, which luckily disclaims me from everything I've said. And with that, I'll leave it and hand you over to Neil to hear the fundamentals.
Thank you, Piers. And you'll be pleased to know that we already have a question for you, and it's not the one that I normally pose. So I'll be interested to hear what you say to that question when I pose it to you very shortly.
I hope my...
So in terms of my sort of starting slides, I wanted to show you a little comparison here. So this is German factory orders going all the way back to the beginning of 2008, so prior to the financial crisis. And that's the left-hand chart. And then on the right-hand chart, we've got a mixture of PMIs for manufacturing from Europe, the UK, and the US. Now, actually, when you look at the German factory orders index and you trace it back to 2008, what you find is that as of April of this year, we're not much different in terms of the index. So you've seen two fairly sizable moves lower in terms of overall factory orders, followed by recoveries, but the recoveries don't really tend to last. So just focus in on that period from 2017 through to 2019. You can actually see that levels of activity for German manufacturers were dropping even prior to the COVID pandemic. And that contrasts quite materially with what we see when we're looking at levels of activity as represented by the manufacturing PMIs. Now, that factory orders number, if you then compare that with German industrial production, it's even worse, because German industrial production is around 5% lower than it was at the beginning of 2008. And so I think what we're seeing is that the COVID recovery is well and truly over. And actually, it's much harder for economies to sustain the momentum that they managed from sort of May, June time of 2020. And I would expect to see quite a sizable and fairly sharp fall in levels of economic output, both from manufacturing but also from services. Now, if we move on to the next slide, then there is another factor for central banks to think about, which is that we may, with the possible exception of the UK, we may be seeing the beginning of the end as far as the rises in inflation rates. For the likes of the US and Euroland, we've seen over the past couple of months a peak and then a drop off in levels of inflation. And that despite the fact that we're still seeing that things like the CRB index rising to record high, not to record highs rather, but to highs that we haven't seen for at least sort of 12 to 15 years. So I think that the question mark is whether inflation can actually sustain the pace that we've already seen. And that regardless of what action central banks are trying to take. Because what central banks appear to be trying to control, in my opinion, remains outside of their control, because it's about a shortage of materials and indeed in a lot of cases a shortage of labour, not excessive demand. And even some of the data that we're seeing out of the US is perhaps falsely indicative of a consumer boom, whereas the reality is that consumers are yet to adjust to lower levels of household disposable income, at least on a real basis. Certainly, as far as the inflation numbers are concerned, there are a few signs, as far as I can see, that average earnings growth is continuing to pick up. In fact, it seems to have plateaued in most countries at around about 5%. So in real terms, earnings are going to be down several percentage points over the course of 2022 and into 2023. I think there will be further net disposable income falls because of the significant changes between inflation from consumer price perspective and earnings inflation. So moving on to the next slide then, what does this mean as far as interest rate expectations are concerned? Well, actually, interest rate expectations have been rebuilt. So you can see that by the end of 2022, US interest rates are expected to be above 3%. UK interest rates are expected to be around 2.5%, and European interest rates are expected to be around 0.75 percentage point. Now, from where we currently sit, those are some fairly aggressive monetary tightenings, and that in spite of the challenges being faced by most of the developed economies, if not the entire global economy. I'm minded to think back to an article only yesterday that was published on most of the newswires talking about the World Bank, who said that the risks of stagflation are significantly increasing. And I think that's absolutely correct, that you are going to potentially lurch into a position where most developed and in fact most developing nations still see inflation because of those labour and material shortages that I've already spoken about. But that the reaction of central banks by tightening monetary policy has prompted a fairly sizable reduction in levels of economic activity. And I think it will also have a negative impact in terms of levels of business investment, if it hasn't already. Certainly some of the anecdotal evidence that we're getting from businesses is that they have cut back materially on the amount that they intend to invest this year because they're faced with a significant cost challenge that they cannot meet by raising prices, or at least not in its entirety. So the interest rate expectations thing is, I think, quite interesting because the markets, I think, are disproportionately pricing in monetary policy tightening, irrespective of the worsening performance of the global economy. I also, the bottom bullet point, I also think that the sustainability of current equity market valuations is being increasingly challenged by the rise in interest rates. So the cost of investing at purportedly zero risk, i.e. putting your money in and taking an interest rate return, is significantly increasing, and therefore the hurdle for equities is getting ever larger as far as sustaining the current price valuations. Moving on to the next slide, and this looks at confidence. The chart on the left-hand side is just consumer confidence for both the UK and the US. It's GfK consumer confidence for the UK, and it's the Conference Board for the United States. You know, these are still very weak, and in fact, they're basically at recession levels. And it's noteworthy that we never really recouped the losses that we saw post the first wave of the pandemic as far as consumer confidence is concerned. We got close, but we never got there. I think the other notable thing is that we are seeing from financial markets that they are more susceptible to significant moves in equity valuations on the back of profit warning. So we saw that from a number of US retailers within the past few weeks. I think there will be further downgrades to profitability for a wide variety of service-based businesses and those that are in the space of discretionary spending. But moreover, I think we could see this spread to more widespread sectors, such as things like the housing market in the US, potentially also the housing market in the UK, where that weak consumer confidence means that you're going to see fewer people taking the plunge with regard to major borrowing, particularly at a time when interest rates are seen as increasing substantially from current levels. So what does all that mean for the FX markets? Well, on the next and final slide that I have, I take a look at the US dollar, and it did make these further gains at the beginning of the quarter. And so if you look back to where we were at the beginning of May, well, you know, euro dollar looked as if it was heading substantially lower. And yet we have seen some recovery, but it's a limited recovery. I mean, it's still a pretty steep downward trend that we're seeing as far as euro dollar is concerned. So let's not get too excited by what we've seen thus far. You know, the give back that we've seen from the US dollar has been relatively small. And it's notable that we're still seeing pressure as far as currencies are concerned in the Far East because of the ongoing COVID problems that they have. And I think a weakening global economic environment may actually play into the US dollar's hands. So this weakness that we've seen over recent weeks as far as the US dollar is concerned could be very quickly reversed. I think that has to be the short-term risk, that if there is a material deterioration in economic activity and in the economic outlook for a lot of these economies, then the short-term risk has to be for a flow of funds back into safe havens like US Treasuries. Consequently, that could see us pushing back lower in sterling dollar and in euro dollar. But let's not forget that the US has a number of both political and economic challenges facing it. So the political challenges are the US midterm elections that are due in November. Will Biden be able to hold on to control of the House and the Senate? And if not, then I think that will severely limit his ability to push through any meaningful policy changes as far as both fiscal policy is concerned, but also in terms of environmental policies as well, which is one of the big things that he was pushing for. Equally as well, I think the Republicans are gearing up to have some sort of fight over the debt ceiling, though the debt ceiling is a pretty laughable concept now, given the $11 trillion that was spent over the pandemic period to try and save the US economy. And clearly, I think there will be a greater degree of fiscal rectitude from some moderate Democrats as well. So I think the possibilities of additional further large spending packages, even in the face of some sizable economic challenges, could cause the US a fair few problems as well. And then notably, finally, I don't think that you're going to see any short or even medium term resolution to the issues around logistics and shipping, nor indeed around the supply of goods because of labour and material shortages. So I think that will probably roll over into 2023. That strength with regard to things like the CRB index, which is an amalgam of a number of key commodities, could offer some support, some short-term support to commodity currencies. So watch for that as well. But overall, I think the FX markets are still pretty volatile. I think liquidity isn't great at the moment. And I certainly think that if there are any big deals that are likely to be done, then the pressure could come on those currencies. Definitely see the risk of pressure on those currencies as we move into the second half of the year. So anything that is associated with risk that isn't a safe haven, I think, could come under pressure as we go into the second half of 2022 if the economic conditions materially worsen. So that's really it from me. The final slide that I have is my disclaimer before we move on to the Q&A session. So that's it from us. Thank you for joining our June webinar. I hope it's been informative. I hope it's been interesting. I hope it's generated a lot of questions. We'll look forward to seeing you again in July. It'll only be me in July. So apologies for that. If you enjoy the technicals, though, Piers will try and drag him back on in the August seminar. And then into the end of the year, I think we're going to have Piers fairly regularly on these webinars, because I think it's going to get a lot more interesting. So again, thank you very much for joining. Have a great rest of the day and the rest of the week, and we look forward to seeing you again soon. Thanks very much and goodbye.